Hello, everybody. My name is Stephanie Wells. Thank you for joining us today. For those of you who have already logged in, this webinar is going to be really targeted to college seniors who are about to graduate and hopefully go into the workforce and start paying back their student loans. So we thought this would be a good time to provide a webinar about managing student loans and repayment for graduating seniors. So that is who our audience is today. If you do have questions about paying for college, if you're a parent of a high school senior, we do have other webinars that would be great for you as well if you want to check those out on our events tab at MEFA.org. So I'm going to get started and just want to let you know that I will stop periodically for questions. So you can type those questions in the chat, in the Q&A feature. We do have the chat disabled, so you won't be able to use that. So feel free, everybody is on mute, to type your questions in the chat, in the Q&A section, and I will answer those. And we are recording today's webinar, so I will send this to you, the recording, as well as copies of these slides. So if you're looking at the slides, and I'm going to point out a bunch of websites, don't worry about having to write them down. We'll provide this PowerPoint to you so that you have everything we're talking about today in one spot after the webinar. So just to get started, my name again is Stephanie Wells. I've been at MEFA 20 years, and I work with colleges in the state and around the country. That's my primary role, and I also do a lot of work helping students and families, from everything from saving to college and guidance, providing them guidance on the financial aid admissions process, as well as right now helping families evaluate their award letters, and of course, college seniors graduating and needing some assistance with repayment options. So a little bit about MEFA. We were created in 1982. We are a nonprofit quasi-state authority. So we were started really to be able to provide a loan option for families at a low cost here in Massachusetts. But since then, we've grown quite a bit to offer college savings plans, refinancing loans, as well as a tremendous amount of guidance. So I definitely recommend checking out MEFA.org if you ever have any questions about education, financing, or paying for college or student loans, and just put that in our search bar and you'll find lots of great webinars that are recorded for you to view, as well as blogs and articles that would be super helpful. And we also, of course, encourage you to sign up for our email curriculum so that we can help keep you on track. So we have a lot to cover in an hour today. Most of you might be on your lunch break, but again, this is really a webinar targeted for seniors in college who are about to graduate and will soon be paying back their student loans. So we're going to talk about budgeting, different repayment options, as well as refinancing, consolidation, and of course, the consequences if you don't make your payments on time and how that can affect a borrower. So first things first, before you even start thinking about how am I going to repay these loans, you do want to put yourself on a budget, especially after graduation. If you have a new job, full-time job after graduation, it might feel like, geez, I have a lot of money coming in the door now that I have a full-time job and I'm making, a decent salary, might be entry-level salary for high school seniors, but you do want to appropriate and budget what you're spending. If you don't know what you're spending your money on, if it seems to go in and go out and, just kind of disappears, then it would be a really good idea, and I've done this myself, to record or write down, whether in a spreadsheet or an app. They have tons of fun apps are out there about budgeting so that you can see everything you're spending in a month. Just try it for 1 month so you can see, okay, from the first to the last day of the month, what did I spend my money on? Keep your receipts or look online, and you'd be surprised how money can sort of just go out the window and you don't even realize it. You might feel like you're not spending a lot, but once you break it down, like all these different line items for your cell phone, your cable bill, all the different streaming services that you might have, it all adds up. And, I sometimes talk about, money that you don't need to spend, but you want to spend. So you really want to differentiate between need and want. So you need to have a roof over your head. You need to have food to eat. Um, and you might want a new car, but if the one you have right now is working fine, then maybe hold off on taking on a additional car expense. So things like that, you really want to think about every month, every penny you're spending. At least try it for a month, just as an exercise. Create a spreadsheet or use an app, and just figure out, okay, where's my money going? So that's a really good way to just start thinking about your budget, is identifying what you're spending your money on. And also what money is coming in the door. What sources of income do you have? Is it just your salary? Do you have investments, or, is mom and dad giving you money? Who knows what it might be, but just understand what's coming in the door and what's going out the door. And at the end of the month, you should have more money left over than what you've spent. That's the goal. So we're going to start with that, but definitely I encourage you to start a budget, not only your cost per month, but what is the annual budget? Because there are some line items in your budget that you might not pay for every month. So, this might sound like a boring type of expense, but for me, having oil heat, a couple times a year I have to get oil. So I'm not on a monthly plan. So I have to plan for that. So, things like that you don't even think about, you want to put that all in here. And revise, month to month as needed. So, as you start paying back your student loans, you're going to want to add those payments in. So you might need to, reduce what you're spending in another area to make room for your student loans. It's always good to create an entertainment budget, because we all want to, go to the movies, go out to dinner. Hopefully we'll be able to do that soon, freely, without masks, things like that. But we're a little bit far away from that right now. But eventually we'll be able to go to concerts and things and ball games, and we'll have more stuff to spend our money on. But the pandemic has definitely helped me personally with not spending so much money on my commute and paying money for parking. So just little things like that you want to think about. So again, I am recording this webinar. If you have questions, please put them in the Q&A section. That is where I will be looking for your questions. So after you created yourself a budget, you do want to gather all your student loan information so that you know what do I owe, when are my payments going to be due, all of that good stuff. So start with your federal student loans, and your financial aid office may already have a program set up for you at the end of the school year for graduating seniors, where they'll provide you with this information or help you, figure it out. But your financial aid office is always a good resource as well. But federal student aid website, studentaid.ed.gov, that is where you can find all of your student loans through the federal government. So it's not going to be a private loan through a banker, lender, or somebody like MEFA. Those won't be in there, but all of your federal student loans will. And for those of you who are just joining us, we will provide these slides after the presentation. So go on the website, make sure that you have reset your password if you don't remember what your password is, so you can log in. And make sure you understand, who you're going to be making your payments to. So it is a federal student loan, but the federal government has lots of loan servicers that they contract with. So you're actually going to be paying through one of those loan servicers, not actually directly to the federal government. And your loan servicer can provide you with your payment amounts and when your first payments are due. So you can add that all into your budget now, and maybe even, start paying down any interest accruing loans that you have if you don't have any other higher interest debt like a credit card. You do want to start with your higher interest debt first, and then set up, your repayments for your student loans. Then if you do have private loans, such as through MEFA or bank or another lender, you'll want to make sure you understand who those lenders are and where you're going to be making your payments. Because many lenders, and I can use MEFA as an example, we also have loan servicer that does the servicing of the loan for our MEFA borrowers. Still a MEFA loan, but you're making your payments through a loan servicer who, has the capability to manage hundreds of thousands of repayments for students. So that's where you'll go to get information on your private student loan. And that is where you will go if you have any trouble paying your student loans as well. You want to really understand who your loan servicers are, download their apps, make sure you can access your accounts. The apps are great these days. I know MEFA's loan servicer has a great app, and so definitely do that. And so after you've figured out, where are my loans, who am I making my payments through, make sure you're creating your online account, downloading the apps, and incorporating those payments into your budget. Even if they're not due now, you can add them to your budget knowing that they're going to become due maybe 6 months after graduation. So that's a good time to do that now. And then once you go into repayment, of course, there'll be lots of payment options for you. I'm going to get into all the different federal loan repayment options. But even if whether you have a private loan or a federal loan, there's auto debit that you can use, or you can just use their app and pay once a month online. I highly recommend using the auto debit, particularly if you have a loan that has on-time payment incentives. You have to be on time with every single payment. So you definitely want to do that. And then you may also, for your federal loans in particular, have a grace period. So typically it might be 6 months after graduation. So for many college seniors that are about to graduate, most of them, their payments will come due in November. That's a typical time when payments start. But you'll want to find out on each of your own loans when your payment starts. So let's talk a little bit about federal student loan repayment. Now, the standard plan that everybody is put on, unless you ask otherwise, is going to be a 10-year plan. That's going to be the most cost-effective way to pay off your loan because you're not extending the loan period. You're not, doing a graduated repayment where you're putting off the full payment for a few years. 10 years standard repayment is going to be the least expensive, but that's also going to have the highest monthly payment in most cases. So you might want to extend your payments to get that lower payment, especially as you're first graduating and you're getting established. Having a lower payment on your student loan, you might be able to do that, especially if it's a lower interest rate. So maybe you can use that extra money to, tackle some credit card debt or use it towards your rent, things like that. If you need to get a new car, other repayment options that push out payment or lower your monthly payment might be good for your budget. However, the further you push out your payment, the longer it's going to take to repay that loan and the more costly it's going to be because interest is always accruing. So it could be a higher cost, but at the end of the day, what's really critical is to make sure that you're paying all your bills on time and maintaining really good credit. That's the most important. And if lowering your monthly payment on your student loans is going to help you keep track with your budget, then that might be a wise thing to do. So the feds have a great tool called the Loan Simulator. And I have the website right here. And again, I will share the PowerPoint with everybody who's registered for the webinar. And that allows you to run different scenarios before you actually consolidate loans, before you go into repayment. If you need to borrow additional loans, how is that going to look? So you can do these simulations. If you want to start paying the loan off early, adding more to your monthly payment, how would that work? This is a great tool to check out and play around with different scenarios before you make a decision on what repayment options you might want to go with. So this slide can be a little overwhelming when we talk about all the different federal student loan repayment options, because there are quite a few. And there has been lots of talk, but again, it's talk right now of consolidating and reducing the vast number of repayment options. So I'm not going to go through every single one of these, but we will just touch on some. And again, you'll have this slide presentation to review afterwards. But again, I mentioned that standard repayment is going to be 10 years. A graduated repayment option, I also mentioned, It's basically still 10 years that you're taking to pay back that loan, but maybe the first 3 years is a much lower payment. And then the next 3 years, the payment goes up a little bit. And then the last 3 years, 3 to 4 years, is a balloon payment. So it's not a fixed repayment over the course of 10 years. They start small and they grow as you, maybe further on in your career, get raises, hopefully, and you're able to make more income, then you can accommodate that higher monthly payment. But for some folks just getting out of college, this graduated repayment option is a good one because you're still paying it off in 10 years. There is lots of other income-based repayment options we'll talk about. I have another slide on that, so I'll get into these in a little bit more detail. But there are ways to just extend your payments beyond just 10 years as well. So 15 years, 20, maybe even 25. So here's an example, in the repayment plans that are in bold are the income-based repayment plans. So if we look at a repayment plan summary for a student called Victoria, she has $40,000 in federal student loan debt. The rate for her loans is 5.5%. Students are in college now, the rate is a little over 2%, so much lower right now, which is a good thing. Her income is $45,000 and she's single and lives here in Massachusetts. And hopefully her income is going to increase at a rate of 5% per year. So that's the calculation. That's what we're using for the calculation here. So you can see the 10-year repayment, her initial payment is going to be $434. And the total interest she's going to pay on that loan is the least of all these repayment options, of a little over $12,000. So, that's a great option. You're going to pay the lowest amount of interest, but maybe that $434 might be a little too steep. Maybe you want to start out with maybe a little less than half that with a graduated or extended, push it out a little bit further. But as you can see, when you look at the column that says total interest paid, the further you push out those loans, the more it's going to cost you. So very important to just remember. Again, folks, if you have questions, please put them in the Q&A, not in the chat feature. I'm not answering questions in the chat feature that was supposed to be disabled for this webinar, so apologize for that. So income-driven repayment plans, I mentioned these a little bit. This is basically, for folks, particularly folks who might be going into lower income paying fields, such as social work, maybe teaching, things like that, that you might start off with a lower income. These could be very helpful. Regardless of which formula they're using, whether it's payment based on income or based on your total debt, you're always going to be paying the lesser of the two. So 20% of discretionary income, it could be 15, 10%. It really depends on the repayment option. What I would recommend is giving your loan servicer a call as you get closer to repayment and having them help you talk through all these options. So, especially over the summer, good time to do that. Hopefully you've secured a job, your payments are coming due in maybe October, November. It's a good time to start thinking about those repayment options and knowing what your budget's going to be. So for federal student loans, those are some of the repayment options. When it comes to private student loans, maybe loans that students have co-signed with mom and dad, for example, you do want to review the lender and the loan servicer websites, download any apps that they might have to help you out with that. Private loans don't have all the options we just talked about. Some private lenders will allow you to choose repayment options when you initially take out the loan. So for example, with MEFA, we have immediate repayment, interest only, and deferred. So when you take out the loan, you can choose one of those repayment options based on the time it takes to pay it back, as well as the interest rates and things like that. But the deferred period is typically going to be, usually if you take out a deferred loan, it might mirror what the federal loans are. So you have about 6 months after graduation, but you do want to find out, okay, when are those student loans coming due if you've deferred your private loans as well. Really important to know what those rates are. Take a look at your billing statements or interest statements if you have those, and get that started ahead of time. So some loan repayment tips. I know I keep talking about the repayment options and understanding your loan, but we talk to a lot of students who don't even realize how much they borrowed or who they borrowed through, and are kind of, they signed on the dotted line a few years ago and they don't remember what they've taken out. So it really is important for you to understand what you have, but also to look at the interest rate on each and every loan and understand what is the total you have for all of your student loans, both federal and private, so that you know what that debt is. If you have other debt, such as credit cards or a car loan that have a higher interest rate than your federal student loans, and you have extra money to put towards, paying one debt off or another, always go with whatever the debt is that has the highest interest rate. Start doubling down on those payments, paying that off, and then go to the next loan or credit card that has the next highest interest rate, and start paying those off one by one, checking those off. So biggest, most important thing to understand when it comes to paying down, not just your loans, but any type of debt, is to make sure you're paying them on time. This will impact your credit report. If you're not making your payments on time, it will impact your ability to borrow not only future education loans, but any type of, car loan, mortgage. It could affect your ability to rent an apartment if you have bad credit, or even to, get a job. Some employers are looking at credit history when looking at it, hiring folks. So it really is critical to maintain good credit, not just for your loans, but for everything that's going to happen in your life. Always use at least, make at least the minimum payment. If you can make more than that to help pay that debt off sooner, definitely try and do that. I always recommend, not just for student loans, but for any payments you have, to use auto debit. So, it's coming right out of your checking account. You don't have to think about it. And that way you're always on time. There is a new program where you can take out without penalty up to $10,000 out of a 529 college savings account to pay off some student loans. So you could do that too. If, maybe mom and dad have money with your college savings accounts that they didn't use it all, but definitely pay off the highest interest rates first. And if possible, have your loan servicer put extra payments towards principal. Again, I'm probably going to talk about importance of good credit throughout the webinar today. But having student loans and making payments on those, especially for, a younger student who's just getting out of college, this can help you establish credit, and establish really good credit if you're making your payments on time. Now, future purchases such as a car loan, maybe even, if you need to get a credit card or a mortgage someday, your credit rate, your credit score and credit rating is going to determine, in most cases, the interest rate that you receive. So the better your credit, the higher your credit score, the lower your interest rate. And again, I mentioned landlords, rental companies, they may be checking credit before they allow you to rent from them. So very good reason to maintain good credit. And bad credit decisions, even 1 month late, that's going to stay on your credit report for a good 7 years. As you go on in time, it becomes less of a factor in your credit score, as long as you continue to make other payments on time. But, even having just one late payment can impact your credit score in a negative way. So make sure that, whatever you're doing, that everything's getting paid on time. You do not want to default on your loans or any credits. That can really put you in a big hole credit-wise. And it can take a good 7 years to get out of that situation before your credit rating is back up to where it was. So I recommend, maybe download the Credit Karma app, so you always know what your credit score is and you can see whether it's going up or down. I like that just as a quick check on my phone. Annualcreditreport.com allows you to pull your full credit history once a year for free. So you can check that out as well. But definitely, even credit card companies now will have information on your credit scores. So it's something that you do want to stay on top of. A high credit score is a good thing, and it can really help you out and help you save money in the future. So again, contact your servicer, not just when you're about to start making payments, but maybe 6 months from now or 6 years from now, maybe you're having some financial difficulties. If you're not able to make your payments on time, then call the lender or loan servicer to try and make some payment arrangements. You know, for your federal student loans, for example, you might say, okay, I'm going to go with that lowest cost 10-year loan. But maybe 2 years from now, that's getting a little steep and you want to change your repayment option. You can do that with your federal student loans. If it's a private loan and you're really in, you know, some financial trouble and you're having a lot of difficulty, the lenders can usually work with you to modify your payments, maybe for 6 months or a year, to help you get out of, you know, whatever hole you're in. And that happens all the time. You know, the economy is hopefully getting better, and hopefully we'll be out of this pandemic soon, but a lot of people are really struggling financially, and you do need to talk to your loan servicers to try and get their help, because they do want to help you. If they don't hear from you, they can't help you. So definitely don't be shy about, you know, answering their calls or giving them a call. And then when you're doing your taxes every year, you can check irs.gov. There are federal tax breaks for your student loan interest, so that is always a good thing as well. You do have to be under certain income levels to qualify, but I definitely recommend checking that out. I believe it's below 75,000 salary for a single filer, where you can deduct a portion of your student loan interest. So that's a good thing as well. So before I get into forgiveness, I want to just take a quick look at the questions here. So auto pay, can we set that up? Definitely, you want to set up auto pay as much as possible. If you're in a master's program or a PhD program, you should be able to continue deferring your federal student loans. You want to talk to your loan servicer, even if it is a program that's out of the country. You do want to talk to your loan servicer to see if you can continue to defer your payments. If it's a federal loan, it might be easier to do that. Private loans, it may not. If your promissory note that you signed doesn't include deferment for grad school, then you're most likely not going to be able to defer your private loans for grad school. Okay, another question about how early can you begin paying back student loans? Is there a benefit for paying the payments while the student's still in college? And the answer to that is yes, you can definitely pay them back. I actually recommend, before students even take out loans, that they plan to pay the interest on their unsubsidized loans while the student's in school, so that before they graduate, whatever interest has accrued won't be capitalized to the principal balance. So that's always a good idea. And just a question about seniors graduating in May. They haven't gotten a bill yet for their student loan payments that are due. That might be because they are in deferment. So if you have any questions about your loans, and if you're expecting a bill, then call your loan servicer for any of those. Another great question: is there a penalty to pay off your loan sooner? And when it comes to an education loan, the answer to that is no. There's no prepayment penalties. You can make larger payments, or make lump sum payments. Maybe just add a little $50 extra a month, whatever you want to do. But that's going to help reduce your interest in the overall term of the loan. So that's a good question. Now, if you used any other type of loan that's not education based, you'd want to check with that lender, or home equity loan, or whatever it might be, to see if there are prepayment penalties. But when it comes to education specific loans, there are no prepayment penalties. Another good question: are the subsidized and unsubsidized loans, are they on separate payment plans? And the answer to that is no. They're usually set up on the same payment plan. Another good question, for your federal student loans, will they all be that you took out through the school's financial aid office? Will they all be paid through the same loan servicer? And the answer to that is hopefully. The federal government has really tried to make it so that all of your federal student loans will be with one loan servicer. So hopefully that is the case. But if you have private loans, they might be through another loan servicer. So it's good to know. Okay, so we have some questions about loan consolidation. I'm going to hold off on answering those because we're going to cover that right now or in a minute. Excuse me. So before we go into consolidation and refinancing, there's this thing called forgiveness that everybody may be hearing about. You're hearing about it in the news every single day. There's a lot of talk about forgiving student loans, 10,000, 50,000, different income levels. We really don't know what's going to happen based on the pandemic talk that's happened over the past year about forgiving student loan debt. None of that has gone through. None of that is official, but there is a lot of talk about it. So who knows, maybe some of that will, be fruitful and legislation will be passed so that that can happen for some students. But basically, forgiveness is a situation where some or all of your student loans are forgiven, and it's typically going to be for your federal student loans. So loan forgiveness can occur for two different reasons: for doing something good or if something bad happens to you. So let's start on the reward side. So public service loan forgiveness, that's one of the most popular, most commonly talked about loan forgiveness options. So folks that are going to public service loan forgiveness, public service fields, and you can find that website out on studentaid.ed.gov, which is a website that's on this PowerPoint, or even just Google public service loan forgiveness and make sure you're going to the .gov site to get more information about what those occupations are. But just in general, it could be social work, military, firefighters, public servants, things like that, that are going to fall under the occupations that are eligible. There are additional forgiveness programs that you can check out as well. So they're all listed here. Teacher loan forgiveness, for example. And so I definitely recommend that you check out those options if you think they might apply to you. So a little bit more about the public service loan forgiveness. It forgives your loan balance after 120 qualifying payments, so 10 years of payments. And those payments don't have to be consecutive. So you could be making payments for 5 years, go to grad school, take 3 years off from payments, and then start paying again for another 5 years. So you can do that. So they don't have to be consecutive, but you do have to be working for a qualified employer, a government organization, 50c3, other nonprofits. So that list is here. There's a public service loan forgiveness help tool. The website's right here in the last bullet, so you can check that out to get all the details about this. Now, only your federal direct student loans are going to qualify for this forgiveness, and only payments made after October 1st of 2007 will qualify. Now, you would need to be on some sort of income-driven or repayment plan to qualify for student loan forgiveness. So, for example, if you did a standard 10-year plan, then at the end of 10 years, your loan will be paid off. So you were not going to really benefit from this public service loan forgiveness if you're not in a repayment plan that pushes out your program, pushes out your payments beyond the 10 years. So you do have to, do some research and talk to your loan servicer and check that out before, making decisions on whether you want to pay off debt or what repayment option you want. A couple other common ones: teacher loan forgiveness. They have to teach at least 5 years and consecutive. Must teach in a school or agency that's in a low income area. Only direct loans qualify, and only up to $17,500 can be forgiven. So not the full amount. If you have any old Perkins loans, there's also cancellation and discharge for those for public service programs. So those are listed here. And again, you can contact your school that lent you that Perkins loan for more details. So forgiveness can also happen if something, God forbid, bad happens to you. So maybe, death of the student or the borrower, there might be eligibility. For example, if a parent took out a federal parent loan for a student and the student passed away, they could get that loan discharged. God forbid something like that should happen. There are total and permanent disability benefits for discharge on the federal student loans. We've heard about some for-profit schools who have violated laws where students' loans were forgiven that they took out because it was a scam, things like that. Maybe the school closed while the student was still enrolled. So there are options there that you can check out if you think you might fall under this category. But you are going to have to, regardless, for all of these options, complete an application and provide documentation to get this taken care of. So avoiding and recovering from delinquency and default. So after all of this, if you find yourself, still having trouble and, you've gone into delinquency or you have gone into default, there are ways to get out of it. There is some light at the end of the tunnel. So I just want to clarify the difference between a couple key words here first. Deferment or forbearance, two very different things. Both mean that you can suspend your payments. Deferment, you can suspend your payments or postpone them. Usually it's in school, while you're in school. Whereas forbearance, you can suspend your payments or have them reduced, maybe in a modified plan. Of course, you'll have to meet eligibility requirements and, work with your loan servicer to get these put in place. But with deferment, if you have a subsidized loan, interest will not accrue on that while you're in deferment. However, if you're in a forbearance, it's a different type of program, then you would have interest being accrued on those loans. So here's some of the reasons why folks might defer or forbear their payments. So deferment, if you're unemployed, suffering economic hardship, maybe you're in college, going into grad school, you can still defer your undergrad loans, military, Peace Corps, rehab training programs, things like that. You might be all eligible for deferment. Forbearance is a little bit different, where you're suspending payments or you might be reducing your payments. If you're not in a qualifying scenario for deferment, then forbearance might be a good option for you. So maybe you're not still in school, but you're in an internship or residency for medical or dental school. So you've gone through school, but now you're in your residency. So you can't automatically defer your loans, but you could forbear them. AmeriCorps, teacher loan service for teacher loan forgiveness, National Guard, there could be medical reasons. So bottom line is talk to your loan servicer to understand what your options might be if you think you might qualify in any of these programs. So delinquency is going to begin the day after your due date, your payment due date, if the full payment is not made. Now, if it's 1 day late, will that impact your credit score? Is the lender going to report you to your credit bureau if you're 1 day late? In most cases, maybe not. Some lenders have a day or two, waiving, grace period for that. But you might have a late fee if you're not up to date on your payment. So you don't want to start getting delinquencies, because delinquencies will lead to defaults. Typically, you'd have to check, but typically anything over 30 days late is going to be reported to the credit bureau. And that's across the board for most types of debt. Default is a much, worse situation, where if you go 270 days of not making payments where your loans are delinquent, then it goes into default. And that can have a lot of very negative ramifications. So delinquency is obviously going to impact your credit score and hurt your credit rating, but you can recover from that after many years of making on-time payments. Default has a lot more severe consequences. So loan servicers, they are doing everything they can to prevent you from going into default. So annoying calls, emails that you get, it's all to help you stay in a good path and paying back your loans and not go into delinquency or default. That's why they're emailing you. That's why they're contacting you, because they want to help. And that's who you should contact to get some help, your loan servicer. Usually loan servicers will want the borrower to make some form of payment if they can, because that interest is accruing when you're in deferment or default or forbearance. It's still going to keep accruing. So they want to at least help you by having you make small payments, at least to address it towards the interest, even if you're not paying down the principal. But your loan servicer is the agency that you're going to go to for help with this. So what happens if you go into default on your student loans? You know, a lot of negative things can happen. Obviously, it's reported to the credit bureaus, so it's going to have a negative impact on your credit score, but you're not going to be able to get federal aid, including federal student loans, until you're out of default. So if you take a year or two off from school, go into default, you're not going to be able to re-enter or at least get student aid to pay for school until you're out of default. Sometimes the loan might become immediately due and payable in full, or you can be put on a payment plan with a collection agency who can put you on a payment plan. You may lose your repayment options in any on-time payment incentives that you might have had, and you might lose options for deferment and forbearance that you're currently eligible for. You could have your wages garnished and your tax refunds garnished as well from the federal government. So it is something you want to avoid at all costs. And you can do that by contacting your loan servicer. Even if you can't make payments, that's okay. Call them to try and see what they can do to help you out, to put you on a path where you can stay in good standing on your loans. So if you do end up in default, there are multiple ways you can get out of default. You can pay the loan off in full. You can consolidate your loans after making 3 consecutive payments. So consolidating your loans, and I'll talk about consolidating in a minute. It allows you to consolidate all your loans and maybe push out the repayment term beyond 10 years so that those monthly payments are much lower and you can afford them. There's also this thing called loan rehabilitation, where you make 9 on-time payments within a period of 10 months so that that will help get you out of default. So then, your credit rating is going to take more time to repair, but at least you'll be out of default so that you can get student aid, federal student aid, and borrow, additional federal student loans if you need to complete your program. So I'm going to talk about consolidation and refinancing, and I'll check the questions in a minute. But if you do have any questions, feel free to put those in the Q&A feature, and we will get those answered for you. So federal loan consolidation is only going to be able to affect your federal student loans. If you have a private loan with a bank or lender, that you can't consolidate your loans. So there's 2 things. There's consolidation, and then there's refinance. Similar, but very different. Consolidation is when you combine your loans and you have a weighted average of all of those rates for your federal student loans. So you're combining into one new loan that you might, with that bigger balance, be able to extend over a longer period of time to reduce your monthly payment. But it is a weighted average of all the rates. Whereas refinancing, you're paying off whatever loans you want to refinance and taking out a new loan with could be different benefits, different repayment terms. The old loans no longer exist. And it could be hopefully a lower rate. So 2 very different things. The loans for federal loan consolidation, the loans must be in repayment or in your grace period. So if you're in school, you're not going to be able to consolidate your loans until you graduate. Several repayment plans with a federal loan consolidation program, you can have 10 to 30 years to pay down that loan, and it's going to be based on your debt amount. So the higher your debt, the longer you're eligible to repay those loans. Now, if mom or dad took out a PLUS loan for the student cannot consolidate that PLUS loan that the parent took out because they're not on that promissory note. In order to consolidate your federal loans, you have to be the borrower on those federal loans. Now, mom or dad can consolidate their federal PLUS loans on their own, but they wouldn't be able to take in the student's federal student loans either. And there's no application fees, and you can apply or do some more research on studentaid.gov. So some things to consider, some benefits. You get one bill a month, especially if you have your loans with multiple loan servicers, which, the feds have been trying to keep that from happening, but it could happen. You could potentially lower your monthly payments if you extend your term out beyond 10 years. It could be, a good alternative. Instead of using one of the repayment plans that are available, you could consolidate. If you took out any variable rate loans, you may be able to, by consolidating, getting a fixed rate loan. However, remember, if you did have borrower benefits with your previous loan, you would lose those if you consolidate them. And as a reminder, increasing the loan term is always going to increase the loan cost. Now, education loan refinancing is a little bit different. It's similar because you're combining, one or more loans, but you're doing it through a private lender, such as a loan through MEFA, for example. We have a MEFA refinancing loan. Now, with education loan refinancing, you can refinance your federal and private loans together. However, you want to be careful if you decide you want to refinance your federal student loans. All these benefits that we've talked about, forbearance, all those repayment options, public service loan forgiveness on your federal student loans, everything we've just talked about on the federal program goes away if you refinance in with a private loan provider. So, you're going to lose those federal loan benefits. You may decide that that's okay and that's something you want to do, but make sure you understand what the ramifications are for financing your federal student loans. Lots of lenders are available. You can check out loan comparison tools, check out MEFA.org to get information on our rates. They're usually, very low right now. And typically most lenders offer fixed and variable rates. So you could see a reduction in rate, reduction in payment, and reduction in costs by refinancing. Now back to the credit score that I keep harping on about. The stronger your credit, the lower your rate if you're refinancing your loans. So that good credit score is going to impact everything going forward when it comes to finance. Now, this might not be the best option for everyone, especially if you don't have great credit or, you only have federal loans and you don't want to consolidate them. But it could, it could result in substantial savings if you're able to lock in a really low fixed rate. So just a quick summary comparison. Our federal, between the consolidation program and refinancing, federal loans are eligible for both. Private loans are eligible only in refinancing, not consolidation. Consolidation does not require a credit check, but refinancing does. As we just mentioned, it can lower your rate. Federal student loan consolidation is not going to reduce your interest rates. However, with refinancing, you could reduce your interest rates depending on your credit rating and the current rates that are available. On both programs, you may save money depending on which option you're choosing. But the nice thing with both is that you're just going to get one bill. So everything is in one place, which is nice. Few factors to consider, again, when refinancing, you have that one bill, which is great. You could potentially get lower interest rates. So our MEFA refi rates start, with people with the highest credit scores is start at little over 3% to a little over 5%, depending on what your credit rating is and which, whether you do a 7, 10, or 15-year repayment. So you could lock in a nice low rate, especially right now where rates are low. If you have a variable rate and you kind of want to get rid of that and switch over to a fixed rate, refinancing is a good option. But again, you lose your borrower benefits if you have any with the loans you're refinancing. And if you're increasing the loan period, let's say you have a 10-year loan now, you increase it to a 15-year through refinancing, even if you're able to get a lower rate, it still may be total cost may be higher because you're taking 5 extra years to pay that back. So definitely play around with the calculators. There's lots of them out there on the lender websites to see if it's going to be a good option for you. And always talk to your loan servicer to understand your repayment options. So I'm going to just show you a few quick resources, and then I'm going to open it up for Q&A. So please send those questions in the Q&A feature. So again, I'm going to send this PowerPoint to everybody along with the recording of the webinar. Bunch of great websites for you to check out here. MEFA.org, of course, we have all that great manage your student loan information, our refi loan, studentaid.ed.gov, primary website for all of your federal student loan needs, irs.gov to look at interest deductions on your federal taxes. Credible is a good place to go to when you're looking at, loans and refinancing options, comparing. I mentioned Credit Karma, one that I personally use on my phone. It's free. I don't pay for any extra services, and I'm able to just, monitor my credit score and make sure everything's looking good. Nothing's going out of whack there. And I like looking at my credit score every month, sometimes a couple times a month, just to see, that extra money I'm paying down on that debt, is it helping my credit score? Or let's say, you charged a vacation and you increased your debt on your credit scores, you might see that lower your credit score. So it really depends on what you're doing, but definitely I love the idea of keeping track of your credit. Please definitely follow us on social media, LinkedIn, YouTube, Facebook, Twitter, of course. We're always sending out great information, blogs on loan repayment and budgeting and just being a wise borrower. So please, connect with us as much as you can. If you have questions after today's webinar, feel free to call us. Our website's right here, collegeplanning@mefa.org. You will get a survey, so we hope you'll fill that out and go on Google to leave us a review with your 5 stars. Hopefully this was very helpful for folks. And for those who are able to attend today, I'm really happy you were able to join us. So thank you for coming. And we will follow up with a recording of this webinar as well as the PowerPoint slides. So with that, I want to invite everybody to put in their Q&A in the Q&A feature. For those who do have to leave and end, that's okay. We want to thank you for coming. So let's see here what we have for questions. So there was a question about consolidation of loans, whether it's private or government, and I think we answered that. Consolidation is just for your federal government loans. And then a question, would you recommend consolidating? I would, take everything we just discussed and kind of, weigh all your options and call your lender or loan servicer if you want to kind of chat through your options, and use the calculators that are online to play around with the numbers to see how that consolidating or refinancing would impact your rate and total cost and monthly payment. So another great question, can you pay off your loans while in deferment? And the answer is absolutely yes. You can pay them down, pay them off, whatever you prefer. Anything regarding an education loan, you can pay those early without penalty. So that's always a good idea to do if you're able to. Okay, so I don't see any more questions here. So I am going to end the webinar for everybody. We are just a few minutes under an hour, so that's good. Everybody can enjoy the rest of their day and have a great weekend. Some of you may have a long weekend for Easter weekend, but I want to thank everybody for coming. Appreciate all the great questions, and have a great day. Thanks, everybody.